But as we showed early on in the example, when we're owning a stock, we want to see these companies invest in things that we personally can't invest in, because there's absolutely no doubt when you receive a dividend, it is a phenomenal feeling. You did nothing, and all of a sudden you go to your brokerage account and see that there's some funds there just for you to distribute how you want to distribute them. But is it really that easy just to buy high yield dividend stocks, put your money in there, and think that your investments are going to go up? What you have to understand about dividends is they're very appealing, but dividends are not total returns. And so in this video, we're going to talk through dividends, how you can stay away from some traps, and what you should be really looking for when buying a stock. So let's say you own company ABC and they're profitable. You bought them for $10 a share. And so now the company can do a few different things with these profits. They can obviously pay down debt, look to make acquisitions, invest in research and development, buy back stock. And of course, the most popular thing that people like is that they could pay a dividend. And so let's just say that ABC decides to pay a dividend of $1. So now the stock is worth $9 and you have $1 to invest now. So nothing changed with the value of your brokerage account. The company took from one pocket and gave to you. Now it's up to you to invest that money. But no additional value was created here because it came from profits. And let's just say that that company was earning $2 a share in EPS and was trading right around 5 times earnings. Now, a different scenario would be, so now buying that same ABC company, let's just say management makes some different moves here. Instead of paying a $1 dividend, they said that they decide to do 50 cents in research and development and 50 cents into buybacks. And let's say they deployed that capital fairly well and were able to grow earnings in the next year right around 10%, which means now earnings are sitting at $2.20 versus staying stagnant with $2 of EPS. Now, if we put a 5 multiple on that, we have an $11 stock. But what doesn't really get mentioned is when a company is growing earnings aggressively, what ends up happening, you normally get a higher multiple on the stock. When earnings remain flat or they're declining, the stock price goes down and the multiple goes down. But when earnings are still in a growth mode, you normally get a premium multiple on that. So instead of 5 times, we could be looking at 8 to 10 times earnings, and we probably get closer to maybe a $14 to $16 stock price on the same company, but instead of them paying the dividend, they're investing in research and development, they're buying back stock, and they're getting a higher multiple because their earnings growth is stronger. And so this is something that kind of gets overlooked when we look at these high yield dividend type stocks. So just using that example of paying a dividend versus buying back stock and growing EPS, we see that example 1, we basically got a 10% rate of return. The company paid a dividend. The stock went from $10 down to $9. We received $1, and maybe the price recouped back up to $10 by the end of the year, which gave us a 12-month 10% rate of return. Not the most tax efficient way, may I add, depending on what kind of account it's in. But then in example 2, we're growing earnings and we could receive multiple expansion. And obviously there could be greater compound effects that take place with the earnings per share basis. And so instead of just getting a $10 stock with a dividend, we could possibly have a $14, $15, or even a $16 stock, depending on how well the company deployed capital, and because normally stock prices follow earnings per share. So if earnings per share are growing, then stock price is going to follow that. So I think a great example of this would be looking at a company like Verizon. Roughly 5 years ago, Verizon was trading for $60 a share, and the stock is down nearly 50% from those levels. Yes, it has a recent rally, so now down closer to 35% from those levels. But take a look at this juicy dividend that it pays, 6.6%. We're seeing it trade for a low multiple. So what is that possibly telling us? It's possibly telling us that EPS is either flat or declining. So if we think about a stock that's paying around a 6% dividend, but the stock's down roughly 30% over the last 4 to 5 years, if you reinvested those dividends, maybe you're sitting around flat at this point in time, but you've massively underperformed a market because while you've invested that 6% dividend and maybe you're flat to slightly down, the S&P 500 or the SPY index is up 80% in that same time frame. In 2019, the company was doing $4.65 of EPS and is now doing $5.06 of EPS. And that EPS is actually down from the year prior, down right around 5%. As I was stating earlier, what is usually happening when earnings are growing? well, the stock price is going to grow. And what happens when earnings are contracting? The stock price is going to fall. So what are we noticing when we're buying stocks in general? Well, we want earnings to be going in an upward direction along with revenue and free cash flow. So as we see by this example, revenue has slightly ticked up, EPS has slightly ticked up, but take a look at free cash flow. Free cash flow was right around $18 billion, up to $23.5 billion, $19 billion, and now is sitting at $14 billion. So while top line revenue growth is kind of stagnant here, and while EPS is kind of stagnant over the last 4 to 5 years, we're also seeing cash flows come down. So what are we noticing? These high dividend yields usually mean that the stock itself has actually underperformed. And so we want to make sure that there's nothing fundamentally wrong with the stock. As we went through Verizon, what did we see? Well, cash flows are coming down, revenue's kind of been flat, and earnings per share is nothing to write home about. And so when we look at the dividend payout ratio on a company like Verizon, fairly high, but I think it's going to be okay here as long as they can maintain decent EPS. And that's why EPS growth is just as important as paying out that dividend. We want to see EPS growth along with dividend growth and along with top line revenue growth and free cash flow growth. When you get all of that together, usually a pretty good sign that you have a strong fundamental company here. But when we're talking about total returns, it's not just about the dividend yield. We have to look at the total market returns here. What was the appreciation of the stock itself along with reinvestments of dividends? That gives us a total rate of return. It's really, really important that we're not just looking at the dividend yield, but we're actually digging into the true fundamentals of the company. So hopefully everybody enjoyed my dive into juicy dividends, things to watch out for, some things to pay attention to when you are looking at these juicy dividends. Now, maybe you are coming across dividends that are paying over 4 and 5% that have the ability to grow EPS. They're still growing revenue. The free cash flow is growing. They're not diluting. If those things are taking place, you might be onto a very, very solid company. As we showed early on in the example, when we're owning a stock, we want to see these companies invest in things that we personally can't invest in. But instead of receiving a small dividend, wouldn't you rather see this company invest in innovation and grow revenue and grow EPS? Because in the end, that's really what's going to compound the stock. Don't get me wrong, reinvesting dividends is just as important, but to get that exponential growth, you want to see companies deploying capital, doing mergers and acquisitions, research and development, buying back stock, and lastly, paying a dividend. Hopefully everybody enjoyed that, and we will see you in the next one.